Hello, everyone, and welcome back to Classic Comics. So, recently I did a video on how comic book companies are bankrupt. Essentially, the whole comic book industry is bankrupt. And I'll put a link to that video up in the corner here. But as we had the end of year stock reports coming out, it's also become pretty apparent that Hollywood is on the course to bankruptcy itself. Now, I don't think that Hollywood studios are ever going to actually go bankrupt because even if they did, the government would probably step in and bail them out. In fact, I mean, they practically did that already during the pandemic. They offered those PPP loans, and those were, of course, were supposed to go to generally like small businesses to help them stay solvent because the government forced them all to shut down. But big corporations and conglomerates and big studios swept in and gobbled up most of that money themselves. So I don't think that Hollywood's in any danger of going broke. Most late year earnings reports showed that most Hollywood studios are pretty much just bleeding money. And we're going to go through this article here and kind of look at what it tells us. So Hollywood stocks fall sharply in 2022 amid ad challenges focus on streaming profits. So Netflix's stock may have been immune to the coronavirus pandemic and risen even during the volatile 2021, but it couldn't escape seeing its own shares and most other Hollywood stocks being brought down to earth in 2022. The streamer ended trading Thursday at $290, down 58% over the last 12 months. After often being seen as an unstoppable juggernaut, the Reed Hastings and Ted Sarandos led company reported its first subscriber loss in more than a decade on April 19th. That shocked investors and sent its shares down more than 35%, which marked the firm's biggest one day share price collapse. Netflix vowed to pull back on some of its spending plans, subsequently launched a lower priced advertising tier in key markets, and is set to roll out a plan to charge users for password sharing in 2023. Those initiatives and the fact that the streamer returned to subscriber growth in the third quarter, adding 2.4 million subscribers for a total of 223 million globally, has made some analysts more optimistic while others remain in wait and see mode. It was also a rough year elsewhere for entertainment conglomerates and their stocks. Cord cutting, while nothing new for traditional pay TV providers, accelerated in 2022 and wreaked havoc on subscribers and cable network units, which have been the traditional profit centers of sector giants. That wasn't all. The industry also faced questions about its ability to reverse declines with a pivot to streaming. Investors asked when big content spending to drive subscriber growth would lead to streaming profitability. That left Wall Street running its ruler more closely over content and other spending decisions in streaming. And more broadly, companies have ended the year reviewing their organizations to find restructuring, optimization, and cost cutting opportunities. Ultimately, sector biggies saw their stocks finish 2022 down sharply, often underperforming the drop in the broad-based S&P 500 stock index, which fell 19.5% as of December 29th. In the past year, media and entertainment stocks saw streaming growth suddenly moderate, advertising and reopening tailwinds turn to recessionary headwinds, cord cutting accelerate, and rising interest rates drive down multiples. As a result, 75% of the 27 companies in our media and entertainment coverage group underperformed the S&P 500. In other words, Stonks is down. The Walt Disney Company, for example, marked its biggest stock drop in decades after it struggled with the likes of bigger than expected streaming losses, 1.47 billion in Q4, more than double the 630 million reported in the comparable period of 2021, and political missteps before surprising Wall Street late in the year by bringing back Bob Iger as CEO to replace Bob Chapek. But with the ultimate box office performance of Avatar The Way of Water still unclear, there was some advertiser debate. Although the sequel made up ground over Christmas weekend and this week, Disney's shares wrapped 2022 down 46% at $87.20 on December 29th. Meanwhile, Warner Brothers Discovery was only created in April when Discovery closed a deal for AT&T's Warner Media, and the merged company's stock had a tough start, falling 63.5% since then and ending the year with a preoccupation on cost cutting and a profit push. Among the early investor and Hollywood debates was management's decision to scrap a nearly finished Batgirl movie for HBO Max and other projects, leading to multiple content write-downs. Warner Brothers Discovery also lowered its full-year financial forecast, citing a $2 billion hit from decisions made during Warner's ownership by AT&T. Elsewhere, a challenging streaming space with peak Peacock losses of $614 million in its latest quarter, up from $520 million in the comparable period a year before, and increased cost-cutting impacted Comcast, which saw its share price fall by 31% in value over the course of the year. Entertainment conglomerate Sony Corporation saw its stock fall by nearly 41% to $76.69 Thursday, even as Sony Pictures posted increased box office sales for theatrical releases this year, like Uncharted, as well as last December's blockbuster Spider Man No Way Home and a boost in TV licensing sales. A muddled entertainment business also impacted Fox Corporation, which saw its shares fall 19% in value as 2022 neared a close, and the Lachlan Murdoch run firm weighs whether to merge itself with the other major piece of the Murdoch family empire, News Corporation, the owner of Dow Jones, the Wall Street Journal, and Australia's Foxtel. An industry occupied by macroeconomic headwinds impacted AMC Networks, which lost its CEO Christina Spade after less than 3 months on the job, and signaled the need for heavy restructuring charges that could hit $475 million amid steep layoffs. Shares in the Walking Dead producer were down 59% for the year as of December 29th. Another beaten down stock for 2022 is Lionsgate, which was down 53.5% to $5.44 on December 29th, as top execs have been talking up the benefits of potentially spinning off its Hollywood studio business just as Starz pivots to the streaming space. The goal appears to be creating two standalone companies so investors can value Starz and studio assets separately. On the exhibition front, the big bets retail's investors placed on parent AMC Entertainment Holdings were greatly reduced in 2022 as shares in the mega exhibitors slid by 40% in value over the last year to close at $4.14 on December 29th. AMC Theaters, led by CEO Adam Aron, has unveiled debt restructuring plans to offset steep borrowings coming out of the pandemic. The continuing economic storm circling the wider theatrical movie business also impacted Cinemark, which saw its stock price fall 48% in 2022. The exhibitor is looking to benefit next year as Hollywood studios lean back into theatrical releases and streaming companies make use of theatrical releases after Netflix unveiled plans to play Glass Onion at Cinemark, AMC, and Regal Cinema locations. Among cinema stocks, IMAX stood out at the year end for gaining Disney's Avatar: The Way of Water movie playing on its screens at premium prices. The technology company, which saw its stock fall by 23% in value over the last year, is betting on higher box office and increased theater signing and installations in 2023, even as there's a question mark over its China box office next year as the country ends its zero COVID policy and virus infections shoot up. Looking ahead, Wells Fargo analyst Steve Cahill expects more difficult times ahead for the entertainment industry in the new year. Our 2023 predictions indicate media and cable sectors are reacting to generally harder times, both cyclical and structural. Tough times mean tough decisions, he wrote in a December 20th report. The Wall Street expert's prediction is for the sector to remain out of favor until at least cyclical pressures abate. In other words, until the general economy turns around, it's going to be tough times for Hollywood. And part of this is, again, just things out of their control. But I think also part of this is just that people are being increasingly disinterested and turned off by what Hollywood is putting out. Disney stock fell 44% in 22 amid tumultuous year. It's been a rough year and a rough week for Disney stock, even as Avatar: The Way of Water continues to bring in dollars at the box office. Shares of Disney finished the year by closing $86.88 on Friday. The stock hit a 52-week low this week and is down 44% over the last year, The decline contributed to making this the worst year for Disney stock since 1974. It has been a troubled year for Disney. The problems began earlier this year when Disney was thrust into controversy over management's lack of response to the legislation known as the Don't Say Gay bill in Florida and subsequent apology. As one of many media companies contending with the high costs of streaming, Disney stock took a particular hit after the company's fourth quarter earnings results in early November, in which the media giant reported growth in streaming subscribers but missed revenue expectations and reported higher streaming losses, even as management signaled this as a peak. Several analysts cut their price targets in light of the growing losses and challenged linear business. This was followed by cost cutting measures announced November 11th, in which then CEO Bob Chapek said the company would freeze hiring and likely begin layoffs. The biggest shakeup, of course, came later that month as Bob Iger returned as CEO. Since then, many investors are still waiting on the sidelines to see what changes will be realized. Wells Fargo analyst Stephen Cahill wrote December 15th shares have fallen 13% in the last month. For now, Cahill said he believes the focus will be on the same content rationalization and cost cutting measures Chapek was eyeing. But looking ahead, Cahill is one of several analysts and investors who see spinning off of ESPN and potentially ABC as well as a strong possibility in order to allow Disney to move away from the linear business. Basically, what they're saying is they think that Disney is going to break off ABC and ESPN and make those separate companies. Now, whether they're talking about just splitting or whether, I mean, that's what they seem to be saying, but or whether I'm sure they'd like to sell those companies off if they could to someone else. But basically, ESPN is primarily a cable channel. ABC, of course, is a traditional broadcast network. Those are two business models that are clearly in decline. And I think what they're saying here is they want to split those companies and separate them from Disney itself so that Disney can be more prosperous without them. Disney's probably going to be looking at layoffs, and you're probably going to see layoffs all over Hollywood in the coming year. And again, Disney is not going to be any stranger to that. In addition to layoffs, they're also going to be reducing content because they need to cut costs. Get woke, go broke, as they say. I don't think that woke content is simply the only explanation for why they're losing money. I think there's a lot of different factors that are figuring into why Hollywood is losing money, but that is definitely part of it. Do you think that Hollywood's financial losses are simply a matter of getting woke and going broke? Or is this partly just cyclical economic issues? Or is it something else completely? Let me know in the comments. Also, please like, share, and sub to the channel and hit the bell for notifications. And I will see you all next time. Thanks for watching.